Welcome to our channel. We are here yet again to give you some information ranging from the stock market to inflation and even bitcoins, along with the respective prices of the shares in different ventures given by none other than the stock market legends Warren Buffett and Charlie Munger. Please watch this video till the end and learn all about it. Now, if you wish to invest and establish a multi-billion-dollar portfolio, or even want a passive source of income, then these lessons given by the legends are a great opportunity for us to begin with. It is just as crazy when more than 50,000 people from all over the world attend the annual meeting of Berkshire Hathaway every year to hear the insights of Warren Buffett and Charlie Munger in Omaha, Nebraska. Let's discuss the important takeaways from this year's annual meeting of Berkshire Hathaway held in Nebraska. Number 1. Fundamentals over technical trading. He mentioned reading The Intelligent Investor when he was about 19 years old and quitting technical analysis as a type of rescue. I visited the New York Stock Exchange and was amazed by it, stated Buffett. I became really interested in technical analysis, charted stocks, tried shorting, and did all kinds of insane things over the course of many hours. All I did was one thing. But when he was 19 or 20 years old, after reading a specific book chapter in what he assumed must have been Benjamin Graham's The Intelligent Investor, his strategy suddenly changed. I read one passage in this book that informed me that I had been acting incorrectly throughout. I simply had the wrong strategy overall, Buffett admitted. Number 2. Timing your move in the market. Well, according to these legends, they have never done anything according to how the market is going to be. Both of them made their decisions at the time when they felt it was right for their companies. According to Warren Buffett, he has never discovered how to time the market. In answer to a query from the audience, Buffett replied, "We hadn't the slightest notion what the stock market was going to do when it opened on Monday." Instead of concentrating on the whims of the stock market, he claimed to follow a value investing strategy, which involves choosing firms with appealing values. Buffett admitted that we have not been adept at timing. We've been able to gauge when we were getting enough value for our money rather well. The market index is short-term, driven by liquidity and mood, whereas long-term stock prices are long-term, driven by individual company earnings. Even in the midst of unfavorable macro headlines like increasing inflation rate, high interest rates, unstable geopolitical tensions, and political unpredictability, in situations like this, great businesses generate substantial wealth over lengthy holding periods throughout market cycles. Regardless of whether the news is good or bad, gruesome firms eventually destroy money. Number 3. Gambling instinct. Since most people don't consider stock market speculation to be gambling, it has been practiced for generations and will likely continue. They perceive it as a chance to become wealthy rapidly since a few other people were fortunate enough to achieve the same thing. But it's a futile endeavor. More trading, more expenses, and unavoidable losses result from it. Millions have attempted it in the past but failed. For those who opt to invest for the long term, there is an advantage to gambling. They, Warren and Charlie, say that the investment market is just like a gambling parlor. Sometimes the capital markets are investment-oriented, as taught in the schools, and sometimes it is extraordinarily a kind of casino. We currently have almost a craze of speculation, according to Munger. Stockbrokers who know even less about stocks are advising clients who know nothing about stocks. Dopamine rushes might cost investors a lot of money. Brokers benefit financially from our actions. We should embrace inactivity and refrain from interfering with the compounding process. Number 4. Stable unit of monetary use or importance of cash asset allocation. Buffett reaffirmed their belief in keeping a lot of cash on hand. Here he made a distinction between treasury bills and commercial paper. The first is money, the second is not. They can make large financial outlays quickly. Berkshire invested more than $40 billion during the first quarter. On March 4th, when they invested $4.6 billion, it had its big day. Still, they have more than $100 billion in cash on hand. Buffett also said, "My mind immediately turned to Michael Saylor and how he used MicroStrategy to acquire Bitcoin." According to remarks he has made, he has no immediate plans to convert Bitcoin into useful assets. The point is Bitcoin. when the loan owed by his business is due. I wonder if he will change his mind. Buffett declared, "We will always have a lot of cash on hand. If you don't have it, you don't get to play the next day," says history. There have been a few instances of this in the past, and there will be more in the future. It's just like oxygen, he continued, it is always present. Yet if it goes away for a short while, everything is lost. A call option on the opportunity is cash. Investors that own sufficient liquid capital becomes antifragile and have considerable option to buy deals when possibilities present themselves. A highly undervalued asset is cash. Cash is one of the few price-stable assets that is also very value-elastic. If other asset prices fall, cash's value rises. The more they drop, the more valuable cash becomes. Have plenty of liquidity, cash reserves, so you won't be forced to liquidate investments during times of market volatility and severe declines. Create an emergency fund equivalent to 2 years' worth of living expenses, and as your exposure to stocks rises over time, gradually expand it to 5 years. Risk exists when you need to spend money but are unable to. Selling an asset for dirt cheap to pay for necessities is the worst thing an investor can do. Number 5. Inflation hedge, your own talent. Great companies have the ability to set prices. They are able to increase the cost of their goods or services without facing competition. When inflation is larger than anticipated, pricing power is quite advantageous. That fantastic company can raise prices without losing money due to inflation. Of course, a competitive advantage like intense customer loyalty, superior patents, stricter regulations, network effects, high switching costs, and low-cost producers is what gives a company price power. To stay ahead of the competition, such advantages must be continuously strengthened and maintained. Earning power is the ideal inflation hedge for people, just like pricing power. Your most valuable asset is your capacity for financial gain. It will be simpler for someone with in-demand talents to increase their pay in line with inflation. But to keep that advantage, those skills must be consistently improved. Learning never ceases. Buffett added a point on inflation to support his earlier statements. In the past, he had claimed that inflation scams equity investors. He said that it also swindles the bond investor. The person who hides their money under their mattress is being conned. It defrauds practically everyone. If you print a lot of money, it will be worth less, according to Munger. How to safeguard one's purchasing power in the face of growing prices was a major issue among shareholders. With inflation at its highest level in 40 years, being extraordinarily good at something is the best thing you can do, according to Buffett. Whatever skills you possess cannot be diminished. They cannot even be inflated away from you. Anything that helps you better yourself is, by far, the best investment, he declared. Being very skilled at something is the path to prosperity. People will pay you handsomely if you are the best at whatever you do, and inflation cannot diminish that worth. No one can take your brilliance away. A more optimistic strategy is to adopt an abundance attitude and concentrate on expanding your earning capacity, rather than adopting a scarcity mindset and cutting back on spending on life's minor pleasures. It is true that cutting your spending will hasten the process of becoming financially independent. There are restrictions on how low your expenses can go, but there are no restrictions on the amount of money you can make. Making an investment in yourself is the best investment you can make. Along with which Buffett expressed his views about how he is not trying to predict future inflation, the amount of inflation we've experienced is tremendous, Buffett added, alluding to rising costs at Nebraska Furniture Mart and other Berkshire affiliates. Inflation forecasting, he continued, is a fool's game, and nobody can truly foresee how much inflation will occur over the course of the next 10 years, a year, or even a few weeks. The greatest way to combat inflation, according to him, is to be skilled at what you do and offer an item or service that people will continue to want and be ready to pay for. Your own personal earning capacity is the best safeguard against inflation. No one can take your talent from you. According to Buffett, it is irrelevant what the US dollar does if you achieve something worthwhile and beneficial for society. Number 6. Owning productive assets. When deciding where to invest their money, investors have many options. Buffett reiterated his preference for holdings that increase owners' wealth. This category includes a wide range of investments, including stocks, bonds, real estate, farming, and more. Recently, traders and the media have become very interested in cryptocurrencies, but Buffett has made it clear that he is not one of them. "I wouldn't accept it if you told me you owned every Bitcoin in the world and offered it to me for $25, because I don't know what I would do with it," said Buffett. According to Buffett, owning a farm creates food, and owning an apartment building generates rental money. But owning cryptocurrencies, like Bitcoin, doesn't generate any income for the owner. That clarifies the distinction between productive assets and items that depend on the next person paying you more than the previous one did, he added. Please be mindful that it's not a professional advice, but rather based on research and experience. That's the end of this video. Join us in the next one.